All right, welcome in. The meeting is being live streamed. It is 12:30 p.m. Pacific time, or excuse me, Eastern time. Let's get that right. 5 seconds in. That means it's the Chit Chat Money Investing Power Hour. My name is Brett Schafer, and I'm joined by Ryan Henderson as always. Today is our show where we cover really anything in investing, finance, business, the FinTwit universe. Ryan, how are you feeling this week? It's kind of the small company earnings are coming through. There's tons of different earnings reports, and it's kind of exciting to see how some of these, small cap growth, small cap value, maybe deep value stuff, some of the companies that soared during the pandemic, kind of how they're recovering as we get back to normal. Anything catch your eye this earnings season besides the two topics I saw you had, which was Coinbase earnings, and then we're going to talk a little bit about Meta's new verification stuff.
Yeah. I don't know if anything really like crazy caught my eye. There were a lot of bad reports that were kind of like interesting, but not in the way that not in an optimistic way. It was I am curious now. We've gone through a period with such like easy money, like or easy borrowing, financing. I'm curious how many when the bankruptcies will start to come, when we'll start to see like some, because we're starting to see, I think, a lot of companies with big cash burns that just can't hold on to it. Because some of the maybe, and we'll talk about this, I guess, with the Coinbase earnings, maybe some of these can be dragged out for a long time. They can just operate unprofitably with all the money they raised for a while.
That is true. That is correct. That burn rate, I guess, is important, but eventually kind of, who said it once, you have to show a little leg to the investment community or else they're never going to believe you.
It's true. It's true. Should we talk about our friends?
Oh, right. Yes. The sponsor before we get into today's episode, Ryan, and why don't you pull up the shared screen so everyone can see
You gotta let me share my screen here.
all right. Technical difficulties. Let's do that quick. No. I always forget how to do it.
I'll let everyone see the Arch Capital portfolio today. Not looking so hot.
Yeah, that is the market's down. Okay, you should be able to share. Yeah, today's episode is presented by Stratosphere, stratosphere.io. It is our investing home screen for fundamental research. As you can see, we have our portfolio loaded up right there. It's super easy. Their dashboard tool lets us easily track our investments and stocks we are researching with a nifty news feed, SEC file aggregation, and a fundamental charting tool to compare companies, plus plenty more that they have to offer. And they're a startup and they're trying to really get their product better. So if you're an early user like ourselves, we're able to, tell them, hey, here's a product that we want, or here's a feature, or here's a KPI that we would like to have, as they're trying to build all these unique KPIs for people. I just messaged them and said, hey, it'd be cool if you could have a thing that tracked employee count at a lot of companies, because almost all companies have to do that on at least an annual basis. And it's something that as a fundamental investor, we would like to track as well. And it's very hard to find that. And they said, yeah, we're working on it right now. So the product is just getting better day in and day out. And there's plenty more that they have to offer. And you can try it for free. That is the best part. For free at stratosphere.io. The link is in the show notes. That is stratosphere.io, and use promo code CCM for 15% off any paid plan. We love Stratosphere, and we think any listener of the show who likes fundamental research will as well. Okay, Ryan.
You see this change?
The bar charts. The bar charts. Well, we will be utilizing. I'm sure we'll be utilizing. Yeah, I'm going to be utilizing some of their long-term, what do you call them, earnings charts, or kind of you can go, see the multiple decade charts on operating income, stuff like that. And I want to look at that for Walmart because I think it's pretty interesting. We're going to look at their earnings. But why don't you go first, Ryan, talking about Coinbase earnings? How were they? I didn't look. I didn't want to look. It's always a tough report to look at because it's like 30 pages of nonsense, right? Gobbledygook.
Oh God, yeah. No, it's a headache to read some like the shareholder letter because they just mask everything. They just basically, it's not even like they just paint every bad piece of news in such a good light. Like, okay, we were fined 50 million by this regulatory body. Like, it's awesome that we settled that. Like, okay, you were fined 50 million. Or oh, like this is a crypto. This is another where we're at the bad part of the cycle. That's, that'll be positive coming out the other side. I'm like, okay, your numbers are horrible. And I even read a part of this. And here, wait, let me just go through some of the numbers because people might care. So total revenue year over year dropped by 76%. It was actually up quarter over quarter. I'll explain why that was, but they have they have a couple ways of generating money, but there's transaction revenue, which is sort of your typical exchange commission based. And transaction revenue declined 86% year over year, and it also dropped sequentially, so quarter over quarter. However, they have the second line item, which is subscription and services revenue. There's a couple of things in there. All of them, minus one item, continued to decline. So all their other subscriptions that they offer saw revenue fall. However, there was one part, interest income, which last year in Q4 was at $7 million, and now it's at $182 million.
And that is that the stuff they're loaning to people or stuff that they're earning just from cash on their balance sheet? Which
so part of it is
it's fiat,
which is
right?
not a subscription. So part of it.
First off, yeah, you're right. It's not. It's fiat though. I want to say it's fiat. It's not.
It's fiat in both cases, actually. So there's two things that are driving this. So the first one is they levered up in 2020. I think they got a bunch of convertibles. And now they just have cash sitting on the balance sheet. So they just buy treasuries and they think they earn like 40 something million in interest each quarter right now, which, listen, like maybe just take your gains and go. Like you got free money at the top of the cycle or at the top of the bubble, and you have a real business where you could literally just take the cash and earn $40 million in interest every quarter. But when you have a diminishing cash base, that interest income might go away a little bit. So that's my concern is, they could theoretically just survive on this interest income if they just cut everything else to zero, but not going to happen. The other part though is, and I could be getting this wrong, so sorry for any crypto proponents that are out there. We suck with this, but so they entered into this like kind of joint venture with a company called Circle, where they issue USDC, which is like US dollar stablecoin. I think it's just like pegged to the US dollar. It's a crypto that's the US dollar. And so what happens is I believe if I want to buy USDC, I will put up, $30 worth of US dollars, and I'll get, and I'm not sure what the price is, $1 US coin, and they will give me interest like a bank account, I believe this, and I think it's like 1.5% annual percentage yield. So I think probably a little less than what you get with like an Ally bank account, and then they earn money on those customer funds. So they just like invest those in interest bearing assets. I believe it's mostly like US treasuries and stuff like that. Could be wrong. It could be some weird staking project. I'm not sure. So it's like offering savings accounts, I think. However, people could just sell their USD. That's a risk too.
Oh, Ryan, you froze on me. Let's go back 5 seconds.
I did?
Yeah. Sorry for any listeners, but keep going.
Oh, my apologies. Yeah. So they just sell on USDC, which is essentially like giving them a savings account. But anyway, they could sell the USDC, so that part's slightly at risk. But the other part is interest bearing on the cash on their balance sheet. So that led to the quarter over quarter revenue increase in total. My question here is like, how is that? Doesn't it feel disingenuous to say that subscription and services revenue you're just like buying treasuries. Is that a subscription? I
Yeah,
don't
it's not
know.
a service.
But
It's definitely not a service because yeah, usually people, and I've noticed this among a lot of tech companies, maybe a lot of fintech ones as well, where they're trying to say they really have this subscription and services side, or they define a segment like that because the investment community really likes to see subscription revenue. They like to see service revenue, and they put a high multiple on that. But I guess sometimes, most of the times they're legit, but sometimes with Coinbase, you dig into it and you say, okay, you're defining it as this, but in reality, you're just earning, interest on the customer balances.
yeah. Here's the other good stuff. Free cash flow for the year, or free cash outflow, 1.6 billion. So they lost $1.6 billion in free cash flow. However, earnings before interest and taxes was negative 3 billion because they paid $1.6 billion in stock-based compensation. So that was the big discrepancy. They also had like a crypto, they had crypto asset impairments. So like the mark to market of the crypto that they hold, basically drop, crypto prices drop. They held the crypto, the sellable value of that crypto has to get marked down according to GAAP. However, it's not in cash flow because you don't lose money until you sell. So as long as they continue to hold it, I guess they're not technically burning cash. But here was the stat that really circulated that was incredible. I've never seen a number like this. Stock-based compensation was 68% of revenue this quarter.
And was free cash flow negative this quarter, or did you not? Most likely, I guess it would
be. I'm pretty sure it was.
So not only do you have,
but I'm like,
yeah, sometimes they don't put the quarterly in there. So you're telling me that not only are they losing cash, but they're diluting shareholders at close to a 70% rate each year. Well, maybe not. Excuse me. Revenue. It might not be at 1x revenue, but they're out of their revenue. They're taking 68% of it, almost 70%, and giving that to employees. It's that's a number. That's a number for sure. And
they didn't give the quarterly operating cash flow.
Yeah. So some companies don't do that.
I know it's always frustrating. I'm like, God, you're really going to make me go to Q3 and do the math. But yeah, I mean, that's an insane number. And also, and there may have been, I think there was like a one-time stock comp benefit that was issued this quarter. So that might have led to part of it, but still it's a ridiculous amount and it's been increasing every quarter. And their guidance for stock-based compensation relative to next quarter's revenue, well, they can't really guide for next quarter's revenue, but that was also pretty egregious. And like, if you're an employee, maybe they don't give you the option. Maybe they're saying you have to take the stock or you can't take, or you'll have like half. You can either have half your compensation in stock or half your compensation. I guess you take the half in stock, but you're kind of jeopardizing your entire employee base. Like if your stock drops again this year, everyone's going to be pissed.
Well, unless they're RSUs, then they'll be okay. And they won't be too upset,
I guess.
I wonder if their RSUs are options. The big thing, though, is that eventually, if people are getting stock comp and the dilution is just crazy, eventually no one makes any money because the dilution just takes care of everything and everything just gets watered down too much. I wonder if, well, here's two questions. One, this is a little bit rhetorical. What are the employees doing at Coinbase all day? I want to know. Two, I don't think they would be able to have all these employees if they paid in cash because they're already burning cash. They would need to probably fire 20%, 30% of their employees if they got rid of all this SBC. So yeah, I think that's my two thoughts
too.
Yeah, well, they'd have to fire
for sure
even more.
Yeah, no, I'm sure they would. Yeah, I don't know what they're spending money on or what the employees are doing on a daily basis. The thing is, and the beauty of an exchange is theoretically you don't need that many employees.
And theoretically margins are very, very high.
But what's that quote? In theory is the same as practice, and in practice, they're very
Yeah,
different or something like that.
you're.
Uh,
I think you're close on that. You're close on that. Let me see if Stratosphere has any good KPIs on this. But you keep going.
anyway, is there? Would you ever own this? Would you ever own Coinbase at any price?
I saw your question there, so I was thinking about it. And yeah, we've discussed before about how there are companies that, they could go bankrupt and you don't trust the management team, so that you probably wouldn't pay up anything for them just because you think the risk, your equity could be worth zero, regardless of whether you're paying below some sort of book value or some sort of intrinsic value or whatever you want to define it. And I think Coinbase goes into that category, kind of the lowest category we have, where it's never invest no matter the price, because my thinking is everything is that they're doing is worth nothing. Plus, I don't trust management team to allocate capital rationally or return any capital to shareholders, all that good stuff. Agree or disagree?
Last year, no, I think you're right. I want to find the last year or in December of 2021. This is an important lesson. Coinbase traded at a price to free cash flow, I believe it was 3.5 times. So, and there were a lot of people that literally just quoted the trailing earnings or trailing free cash flow and said, like, let's take a flyer on this. Why not? Because it's so cheap. This is an example where the denominator can change, right? The denominator in that case,
Yeah.
where the earnings, quoting trailing earnings on a business that won't generate money in the future is not, it's not the proper way to value anything.
Yeah.
So,
And I got the Stratosphere chart loaded up here. Side note, I did see they have an employees thing I'm circling under their ratio. So they got that out quickly. Not really relevant for Coinbase because they just went public. So you're going to be comparing like 2 years there. But I think that can be so useful for companies that are 20 years, in history. And you have to find that at the bottom of SEC filings. But either way, I got the PE ratio that Ryan is mentioning. If we go back to the latest they have since they just went public, March 2021, PE of 21, June 2021, PE of 8. So you're like, oh, PE of 8. PE is cheap, right? It's below 10. Oh my God, it's great. And then we pop up to PE of 29.4. Then we go back down to 15.7. And then in 2022, we are negative, which means, as Ryan mentioned, they aren't making any money. So I think that just shows that, and we all do this. I think at first, you probably did this too, Ryan. I think we all do it, is when you first start out, you think, okay, low PE ratio, I'm going to buy. But in reality, that is not telling nowhere near the whole story of a stock, especially if you're going to buy an individual investment.
yeah. And also, I think just goes to illustrate how much earnings can change and how quickly they can change. Because I remember, and we even made this mistake where we looked at businesses that were growing 30-40% top line, and we said, well, let's assume a conservative scenario that growth drops down to 10% next year or 5% next year. And in reality, revenue declined. Like it can really swing rapidly. I mean, if you looked at Coinbase and it was growing, I think revenue was growing probably, I don't know, triple digits last year. You could say, well, let's assume something real conservative that it only grows by 5%. And in reality, revenue dropped by 75%. It just goes to show that unless it's a critical service that people are going to pay for regardless of the environment, there's no telling what could happen to the top line.
Yeah. And that, I think, for companies that have been public for a long time, you can really look at, hey, over the last 30 years, have they had revenue declines? What periods were they in? Did they coincide with recessions? And you can tell, okay, if this company had really no periods of major revenue declines, that's a company that might be very, very important to its industry or its customers. And if it's not, like Coinbase, I guess there's other factors like cyclicality, but something like Coinbase might be more of a discretionary thing, or it might be a very cyclical industry. I think we would not describe, some people describe crypto as cyclical. We would describe it as an egg, useless, a zero. That's how we. That's
Yeah.
the
How
camp
many
we fall
times
in.
does
But
something have to drop? How many times does something have to drop before you say, before you can actually determine that it's a cycle? Because
yeah,
if it's dropped twice, if it's dropped 75% twice, I would not say that it's a cyclical industry. It might just not be an industry.
that's right. Yeah, oil, energy,
It's got to happen a couple
some
times, more than a
yeah,
couple times.
some commodity metals. Those could be defined clearly as a cyclical industry. A few others. Crypto, I guess TBD. Maybe it'll just go through a cycle forever. All right. Next topic, Ryan. You have what? Meta verified? I have a hot take on this, but I'll let you discuss it first.
Yeah. So this week, Mark Zuckerberg posted, I think on Facebook, he said, "Good morning and new product announcement. This week, we're starting to roll out Meta Verified, a subscription service that lets you verify your account with a government ID, get a blue badge, so that check mark, get extra impersonation protection against accounts claiming to be you, and get direct access to customer support. This new feature is about increasing authenticity and security across our services. Meta Verified starts at $11.99 a month on the web or $14.99 a month on iOS. A little shot across the bow at old Apple. We'll be rolling out in Australia and New Zealand this week and more countries soon." First of all, I will just say that this subscription feels like bullshit because they're monetizing the worst parts of their platform, saying that we will allow you to actually talk to someone if you're having problems, but you got to pay $15 a month to do it.
We
Seems
can
a little
confirm this
screwed
isn't.
up.
Yeah, we can confirm this isn't just a 8-person team in Russia pretending to be the Church of Latter-day Saints that you've joined a Facebook group on. They should be doing that for free.
And okay, the other stuff, you get extra impersonation protection. So the flaw of your platform that anyone can impersonate anyone else, you're monetizing that. That seems like a bit of an issue. Maybe you do need an ID to potentially do that. I don't know. I'm not on that side, but it's obviously one of the pitfalls of the social media platforms. So I've had an experience where, and I know a lot of people that have had this experience, they got an account hacked. I had an Instagram account. It got hacked a long time ago. Was able to get it back eventually, and just got rid of it because I don't want to have to deal with it again. But you're concerned if you get hacked, you're concerned that whoever the hacker is going to send something to your family or friends or whatever, coming from your account. And so you try to reach out to customer support, which does not exist. The only thing that exists is FAQ, frequently asked questions.
Yeah. I found that with Google as well. not to get on the rant here, but when you're dealing with the mega cap companies, the customer support is a bit weak.
You've got all this AI investments and you can't even have a functioning chatbot that helps you get your account back. Anyway, so now if you pay $15, you can call somebody. That's, I don't know. That feels like just a screwed up subscription. Do you think it'll work?
Well, my question is, okay, here's my hot take, and then I'll have a question for you. I don't think it's gonna work in driving revenue because I don't really think that many people are gonna sign up for it. My hot take is that this entire thing that Zuckerberg is doing is to show that Apple is being pretty egregious with their fees. I think that's the number one reason they're doing this.
That's a pretty lame way to do it, to be honest. I think Apple probably saw that and was like, all right, well, no one's going to sign up for that anyways. Or if they do, I mean, maybe the people that care a lot about their accounts, but do they really care about paying an extra $3 to not have someone shill crap to their family and friends? I don't know. I don't know if he thinks this is the blow to Apple that he thinks it is.
They should start running ads next holiday season. Perfect gift for grandma this holiday season. Is your grandma gotten hacked by joining Facebook groups from Indonesia that are pretending to be the church group from Omaha? Well, Meta verified is for you. Okay, here's the other question I have. I'm looking at the chart here, the KPI chart, that any watchers have been watching for the last 3 minutes. I've been showing them here. And we have DAUs, daily active users at Meta, so across all their stuff, at 2 billion. What's your guess on what percentage of these, say it's rolled out globally, say it's, cheaper in India and stuff like that. What percentage of the DAUs are going to be paying for this?
Less than 1%.
Yeah, I tend to agree.
Well, it'll change. What percentage? I think the most value that the subscription provides is just hacked accounts, which I know is a flaw in the system, whatever. But if you want to get your account back, yeah, you'll probably pay, especially if like this is something that you live for or whatever. You love social media. No one admits that they love social media, but if you spend more than an hour a day on this or something, you're going to pay $15 a month to get your account back.
I could see some people on Instagram using it, because I think as one of the key uses for Instagram is for younger people to try to meet people of the other gender or people that they're attracted to, right? So they want to make sure that those people are real, right? And they're talking to the right person. I think that could be helpful, right? But it's really.
You could have also said $20 a month, no ads.
Yeah,
I think I think having just an ad free would be more beneficial.
Yeah, some people like the Instagram ads though. They use them for buying shit. That's why they're so good. I think
it's true.
They should just offer ID verification for free. It can't be that hard. You partner with a company and they do some ID verification, right? They prove that you're a real person. They have the 2-factor authentication to know what accounts connect or know what devices are connected to you. And they should be able to prove that you're a real person, because that's one of the big issues, I think, holding them back. I think maybe why these platforms are so hesitant to do that, because you're trying to think like, okay, it's so obvious, right? They've probably thought of this. Maybe it would be such a hit to revenue and all the content when all the bots, all the troll farms, all the stuff from all sorts of countries that are posting stuff online pretending to be people, if that goes away, then you lose a lot of the stuff on there. And people are like, oh, wait, I was talking to someone, this thing is just totally fake. Oh, I guess my feed is a little bit worse. Or what do you think on that? It would hurt them, financially, I think maybe is the thing there.
You think like not having bots would hurt them financially?
I believe, and this is the stat, I think it was 19 out of 20 of the most popular Christian groups on Facebook were fake from Russia, wherever, Eastern Europe, something like that. 19 out of 20 at one point. Think about that, all that usage. Think about all the people spending time on there. They're going through the group, they're seeing ads, they're clicking on ads. Those get unverified. I see it because I'm trying to think why they don't offer this for free.
Because they got to pay some customer support people in Indonesia or whatever to do this, and they would rather just have the customers pay for it.
For ID verification, I understand on the support side, but
no,
just to verify your
just
account,
the support.
Yeah,
just the support to get your account back and stuff like that.
That cannot. No way. What is that going to cost them? $1 billion a year? That's chump change to them.
Maybe maybe this whole thing was just to prove that Apple has high fees.
That's my working thesis, because it doesn't make any sense any other way.
All right, let's talk through your news. I'm getting a lag on your audio, so I'm gonna try to change my headphones out and while you're talking.
Okay. All right. My news was an update on the Xbox Activision Blizzard deal. So as anyone who is unaware, the deal's supposed to close this summer. And since it's such a big deal within the video game industry, and I guess the entertainment industry in general, they have to go through all the regulators around the world, especially because both Microsoft through its Xbox platform and Activision Blizzard sell products globally. So you have the regulators in the United Kingdom, the regulators in the United States, regulators in China that are super important. And a lot of them have talked about how they're not going to let the deal go through. So Xbox has been, making new concessions, new offerings, offering things to the industry so regulators around the globe can get more comfortable with its merger. And this week, the Xbox president announced that Xbox/Activision are committed to bringing games to Nintendo hardware for 10 years under a, quote, binding contract. I put up quotes here, but that's just to say what they exactly said. It is a binding contract. And they are also committing to bringing the content to Steam and NVIDIA's GeForce Now cloud gaming service, although GeForce Now, not too relevant. And then as a note, so I guess you kind of have the big, there's 4 big platforms, I guess, in console gaming. Or console and PC gaming, since they overlap. You got Steam, dominates PC as the distribution store. Then in consoles, you have Nintendo, Sony, and Xbox. They've locked up a deal with Nintendo and Steam, and they've offered this 10-year deal to Sony, but they actually haven't gotten any reciprocation. I have a few questions that I think would be fun to discuss here because we follow the industry closely, and I think you can kind of read through the tea leaves here. But thoughts on these new offers in general, Ryan, when you saw the news? Anything to add before we hit these discussion questions?
Well, it makes me feel like the deal's going to go through, for starters, because if this is the concessions they're looking for, the only reason this deal isn't going through is because Sony's holding out. Everyone's going to look at Sony like they're bitter, especially now that everyone else has agreed. I also find it hilarious that, like, I don't know, GeForce Now, they're like, we got GeForce Now. Okay, all 10 users or whatever's on there. It just, yeah, that felt more like Microsoft just saying that everyone else has agreed, even though no one really cares about GeForce Now. And maybe we're wrong. Do you have any idea on user count for GeForce Now?
If we can't get any, I'm assuming it's low because they would brag about it. If NVIDIA is a very press release happy company, and when you see them, if they hit 10 million users, wow, 25 million users, there we go.
Oh, that's not bad.
Yeah, but remember, Oculus this is kind of how many people have downloaded it, and we'll see. I mean, I guess it's better than Stadia from Google. Maybe it's good. Yeah, it says it has 25 million registered users. So I'd like to see the usage on that because people were comparing Oculus to Sony or Oculus to PlayStation when Oculus had basically no usage and Sony was 50 hours a month, something like that. Incredible usage. One of the most used things when people, as their core customers. Maybe we're underselling GeForce Now, but still they're not a big player yet. Either way, any other thoughts, Ryan?
No, just I would say that I'm pretty sure this was the British regulatory body's main concern was them taking COD in-house. And so this, I think, alleviates a lot of that, which means I think if the British regulatory body gives the AOK here, I assume it'll be the same in the EU. I think this deal would probably go through.
Yeah, it's interesting when at first you kind of think Microsoft's the big bad monopoly here, but they have been losing to Xbox. There's a nice tweet here from
Sony.
Or Sony. Yes.
Yeah.
Thank you for the correction. His name's Benji. Well, he goes by Benji Sales on Twitter, popular video game analyst. Don't know his last name, but Benji Sales, be able to find him, I think, by looking him up. During Microsoft's presentation to, I think, regulators, they talked about how PlayStation has dominated Xbox market performance, comparing the two on sales. And if you look at historically, Europe goes favored 80-20 in favor of PlayStation. Japan is 96-4, which I guess is because Sony is a Japanese company. Globally, it's 70-30 in favor of PlayStation. And then end of 2022, it was 69-31. So basically 70-30 as well. Really, Sony has tried to use this method before, and they have used it. They've launched plenty of first-party games exclusive to Sony to try to get people to, switch from Xbox to PlayStation. And what's interesting is if these companies are not able to do the first party exclusive kind of vertical integration thing, I think it bodes well for the third party publishers that aren't, that don't produce their own hardware, because then regulators are going to really be on the watch for anti-competitive behavior from someone like Microsoft if they own Activision Blizzard.
Yeah, that's fair. I mean, I think at this point, like, well, I guess if Activision goes in-house to Microsoft, maybe. I mean, the majority of game time is not spent on Sony or Microsoft's own games right now. So they kind of are at the leash or at the whim, probably, of the third-party publishers in some ways. Obviously, owning the platforms gives you a little bit of power as well. But, the big brands like FIFA, Madden, Call of Duty could, potentially be in-house here. They are going to command probably a lot of the negotiating leverage.
Yeah, I agree.
What do you say?
Yeah, I agree. I don't think it's going to change too much. And if, say, Microsoft tried to pull anything funny with COD, the regulators are going to be right up there, right on them. The other thing that I think was interesting in regards to the Nintendo announcement was the fact that Call of Duty cannot run on the Nintendo Switch right now. So a lot of people are theorizing that this means that the Switch 2 is coming and it's going to be more powerful, because even it would be such a bad experience. And, Nintendo is known for doing that sometimes, but it would be such a bad experience if you ran the modern Call of Duties on the 2017 hardware or 2017 processor on the Nintendo Switch. Yeah. What are your thoughts on that?
Yeah, I think it implies that there's a new iteration of the Switch coming. At this point, it just, I don't know. I saw some tweets about this as well, kind of like the whole thesis rests on whether or not, and it was from Louise, our friend, basically saying the whole thesis rests on, for Nintendo, rests on whether or not they're going to release a new Switch. And I agree, the thesis does rest on that, but I think it is, and maybe there's a chance this doesn't come to fruition, but I think it's pretty obvious now that a new iteration of the Switch will come out.
Yes, I would agree with you that they are. I saw a hesitation in your voice. They are a weird company, so you never know what they're going to do. But I would, and you can't say 100% guarantee on anything, but given what the management is saying now, given what all they've done with Nintendo Switch Online, because why invest all that money to put all the Game Boy, NES, what are the other ones, Nintendo 64 stuff on Nintendo Switch Online if you're just going to drop the platform 1 year later? I think I would probably handicap it as a 95% chance that a Switch 2 is coming out. The name doesn't have to be Switch 2, but an upgraded one is coming out. My bet would be spring 2024, because that's when the Mario Kart DLC ends, and they probably would launch a new Mario Kart along with the new Switch, as that's their flagship game, kind of like
I thought the new Mario Kart DLC was coming out like May timeframe, right with the release of the Mario movie.
Yeah, so that's one of the sections. So if you pay how the DLC works is it started, when was it, last year, I think, in the spring, probably a year ago when they released it. And I think it's $25, maybe $50, but you get different packs every quarter. So I think like a pack of 8 carts if you pay the one-time fee, each quarter you get a pack of 8 new courses or historical courses, and it ends, I believe, spring 2024. So that's kind of my thesis of when they're planning on launching the Switch 2.
All right. You want to talk through the consumer side of things? Walmart's earnings?
Yeah, I think, we hit the other question too on will the deal go through. You already said that. So yeah, let's hit Walmart earnings. I think it could be.
What's the spread on that deal?
On Activision? Well, let's do some quick math.
$96 a share? Something like that.
95. We're at 76.9.
A little over 20%.
Yeah, do a little math. I'm trying to do math in the Google search bar.
And I guess there's no timeline on when it would close, but if you're looking for a speculative or potentially minimized risk 20% return, this has some potential. Although there is
Yeah,
downside if this obviously doesn't go through.
I know. That's the famous last words. It's a low risk 20% bet this summer. I want to know what, I want to know what people are thinking and why the spread is so wide. But I guess there's got to be a reason. There's got to be a reason. And maybe it's because if it breaks, it's going to drop down to $40, $50 a share. Okay. Yes, let's go to consumer. I'll load up some stratosphere charts, which will be very insightful. I thought this was really cool to look at over the multiple decades. So Walmart reported their earnings, fiscal year 23, giving an update on the state of the U.S. consumer. And since they do $600 billion in revenue a year, and the vast majority of that being in the United States, it can be a great indicator on what the economy is doing. Yeah, maybe the people that aren't the ultra rich, but that's okay. We can just look at LVMH results for that. Revenue grew 6.7% in fiscal year 2023, but operating income declined by $5.5 billion to $20.4 billion for the year. I think a bit of that is them trying to win customers over with their low cost stuff during this downturn as other companies are struggling, and a bit of them also struggling to keep up with inflation. And then at $111 billion in revenue, they have a measly operating margin of 3.3%. Before we get to guidance, I'm going to load up this chart here. On Walmart. Let me share the screen. I know it's tough for the listeners, but I will describe what it is because I think it's very fascinating. Okay. Walmart. Oh, there we go. Go quick here to operating margin. They have actually seen declining operating margin since the 90s. So if we look at, let me load it all the way back to as far back as we can go. Oh, let's not go back to all the way when they're unprofitable. All right.
This is gonna be a tough listen.
Yeah, this part especially, I'm trying to load it up quick. But I know what the chart looks like. We'll actually see it here. If we go to the 90s, they had an operating margin of approximately 6%, 7%, something like that. And today, as I just mentioned, we're down to 3.3%. And I I was wondering why that is. Like, okay, what happened? Was it the e-commerce competition? Because it kind of in, January or, fiscal year 2013, they had 6% operating margin, and that kind of been the same as they had been for years. I mean, it declined a bit in the 2002 recession. They held up really well in the 2008-2009 recession. But yeah, if we look back at operating margin in 1995, it was 4.7%, just for reference. But we've seen it decline a ton, and it's down, as I mentioned, 3.3%. I tried to figure out why, tweeted it out, and our friend Jason Hall has been on the show before, said it's because they've won so much market share in grocery, and that has lower margins, but now they've become the one-stop shop for a lot of shoppers out there. On one hand, yeah, that's great. You're getting more volume and it is gross profit positive. On the other hand, though, I kind of think, especially if there's the inflation risk out there, that having so much exposure to grocery can be tough, because would you be surprised if inflation ran hot for 2 more years that Walmart's operating margin continues to slip? It easily could. It's just tough. And even this margin deterioration is happening. Sorry, I'll let you go. When advertising revenue is growing at, I think, a 30% rate and is making up, a larger part of the business now.
Well, yeah. Okay. Part of the recent operating margin deterioration is the inventory management side of things, just having to mark down a bunch of stuff on the inventory side. But I would say if you asked the CEO of Walmart in the 1990s, would you like to be the leader in grocery too? But you're going to have to sacrifice some points on margin, but it'll be clearly gross profit accretive. If you would ask shareholders, ask the CEO, the answer would be yes. I think it was the right thing to do, even though, yeah, it does tighten margins a little bit. It also probably makes inventory a little more difficult because there's a shorter shelf life there. Depreciation's a little quicker, but I I don't know if they'll ever have like a purchasing environment. Well, I shouldn't say this. As big of a swing in purchasing habits as they had in the last 2 years. So it's very easy to mess up. And pretty much every retailer did it that I can think of, messed up inventory in some way where they had significant write downs because of it. So I think margins will probably stabilize here in the future, but
they'll probably stabilize lower. And on the positive side as well, the lower the margin Walmart has, I think, and maybe Costco can compete, but that's kind of a different, they have Sam's Club. The harder would be to compete with Walmart from any sort of startup, any other grocer, even someone like Kroger, because Walmart is willing to go for that lowest margin as possible. That means, especially because their employees are usually not paid that well, no one can compete with them on price and stay profitable. So I think in this case, this is one of those clear examples where the margin is the moat. The low margin is the moat. And as they go lower here, the gross profit might be a little bit weaker. The operating margin might be a little bit weaker, but I think having the dominance in grocery, they mentioned this quarter again that they won market share in grocery, that widens their moat over time. Thoughts on that?
I've looked at a lot of these retailers, and I'd be cautious owning a lot of anyone really in the retail space because, and you mentioned Walmart actually is not that cheap of a, like their wages are not that low relative to some others, if I'm not mistaken. I believe they pay like a decent amount, and they're trying to
I guess,
follow Amazon.
Maybe that was 10 years ago. Yeah, they have gotten better recently. Yeah, correct.
But you've got potentially a big write down environment. Consumer purchasing or the consumer looks weak in general in terms of how much they're wanting to spend, and with inflation, you've got labor jumping or labor costs potentially jumping. It feels like it's just a big recipe for margin compression. So I would be worried, although I think Walmart has, plenty of durability. I'd be worried about the coming years. Maybe Walmart comes out better for it, but yeah, I think just being a retailer right now is just such a difficult period. So many companies had big discounts this quarter, and a couple of them were able to sell more inventory that they thought, but a lot of them were not able to. Which
who are the good ones? Let me guess. Nike, Lululemon. Was that the ones you're thinking of, or no, something else?
I think Nike was solid. Sonos did better than management was expecting. Some of the bad one, Under Armour, did pretty poor. Those were just the couple ones that I remember looking at, but obviously that's kind of brand dependent. I think Walmart has more predictable consumers because it's just value conscious customers that are always going to be there. Whereas I think there's a lot more discretionary spending at those brands, but
yeah, I agree.
don't know. I kind of forgot about your question. So,
well, here's some other notes they had from the news release that I think is interesting, and this kind of plays more to the broader economy. So, guidance for next year, and they did mention that there is some uncertainty here. So they said don't take this as 100% certainty, but they said they are guiding next year for a decent slowdown in growth to 2.5% to 3% in constant currency. If inflation stays high or higher than that, I think that could really impact their margins like you're mentioning. And then on the conference call, the CFO said that they continue to see impacts on discretionary items, which I guess makes sense, as there was a huge boom in discretionary, physical items during the pandemic. And they are being very cautious about how they invest for growth right now or whatever they're doing because of the US savings rate charts. And he was talking about it in executive speak, but he was basically saying, look at that chart. We're at the lowest level ever. People are spending like crazy and it's not that sustainable. And it eventually is going to revert back to normal. So we're going to get impacted by that. And we're trying to prepare for it.
Yeah, I appreciate that. I think there's some CEOs that are very candid about the environment. Walmart apparently, or Walmart's executive team seems to be one of them. Maybe it was the CFO. I can't remember what you said. But the other ones are just kind of, I think, faking it. and saying, yeah, we're seeing this, but we might be immune kind of thing. I don't want to touch retail at all right now. At
Yeah, I think
all.
that makes sense. That makes
Do you think
sense.
that has
Here's
ripple effects on marketing?
ooh, yeah, it's got to at some point. When we've seen companies talk about a lot of advertising companies talk about the impact of the crypto collapse when what was it, a year ago? Probably a year and a half ago at this point, right? During the crypto boom, there was a huge boom in crypto advertising spending. We all saw it, Super Bowl commercials, and that flowed through. Well, not the majority of the digital advertising industry. It did have an impact on their growth, and then when that collapsed and all the advertising has come in now, that actually impacted their business. So I think we're not going to see a 80% drop in advertising from some of these companies, but it does have an impact when your industry goes through a slowdown. There's only
That,
so many dollars out there.
yeah, that is actually something that kind of upset me about. We own IAC, and we read this. I read the shareholder letter, and they have an advertising segment. Basically, they have a business that's run on advertising, and they said we saw year over year declines in advertising revenue, and then they're like, wow, the crypto advertising wasn't sustainable. Who would have seen that coming? And it's like almost taking a shot at crypto. But I'm like, okay, it's one thing if you do that and like you predicted it, like, oh, you thought whatever, it wasn't going to be sustainable. But if you were impacted by it, then you didn't insulate yourself well enough. I'm not sure if they took direct crypto ads, but if they did, then I don't think there's room to like take shots at crypto advertising if you were one of the beneficiaries of it.
Yeah, I mean, whatever.
Would you, I mean, okay, so let's say someone wanted to run a crypto ad on our podcast. Would you compromise on, or you're like, well, this kind of seems suspect, but they're going to pay me. Would you take it?
No, I mean, no. But I think our advertising is different than a programmatic because then you don't know. It's kind of a self-serve, right?
Yeah,
Because
but you
we
can
can
set
really,
parameters.
yeah, that's fair. That's fair. But yeah, I mean, it doesn't really make sense to make fun of your advertisers. And they were talking about making crypto investments in their incubator a year ago, and guessing they just shut that off. So yeah, I think it's strange though, looking at the consumer economy, that doesn't it seem a bit, I'm kind of a bit uneasy because it seems like everything is going, as we stand today, is going through almost exactly what the general consensus has been. And it's really kind of a steady slowdown in discretionary spending. And the boom is over and it's slowly trickling away back to normal, possibly with high inflation, possibly with a small recession. I think that's a bit strange because I'm waiting to get surprised by something. I'm waiting for some sort of shoe to drop, but maybe it's not going to happen this time.
Yeah, it feels like this was the recession that was predicted.
Yeah, it's just kind of been real easy, like not
Just like a
too
steady
bad.
decline. Some, there's going to be difficulty for some people, and it's gonna hurt some retailers. There'll be less spending. People will tighten their budgets because they have to. That was kind of what, as opposed to like one fast dramatic collapse. It feels like that was what everyone was kind of expecting to happen after the big sort of influx of capital from the Fed. They were
Yeah.
like, oh, this will trickle through and reverse, but it'll be slow.
Yeah. And it seems like interest rates so far are working their magic. I mean,
The other
we'll
thing,
see what happens though with the real estate market. As someone who knows nothing about real estate, I am nervous about real estate. We saw there's some commercial real estate people that are going bankrupt, filing for bankruptcy. The residential stuff looks the least, the affordability charts are worse than the GFC right now. And if inflation stays high, man, I wonder what's going to happen there. And I wonder how big the impact could be and how quickly. But you had something else to say?
yeah, I kind of lost my train of thought. But on the residential side, it kind of segues into another piece of news that I saw. Zillow reported earnings this week. Maybe it was
Didn't we talk
last
about
week.
those? We talked about those this last week. We
Okay,
talked about
but
Zillow.
here's the other important part. CoStar Group also reported earnings this week. And CoStar Group's like one of the leading commercial real estate databases, the leading, if I'm not mistaken. However, they also own homes.com, Homes.com said they surpassed 20 million monthly unique users, which was up double from which apparently had traffic doubled in recent months. That, and they have like a much cleaner advertising model for agents. It's just your listing, your lead, that, you pay for the listing, you pay for the lead. I don't like, is Zillow's kind of moat that they've held for so long, which is just that so many users go to their, so many eyeballs go to their platform. Is that finally going to erode? And are they going to have the difficulty of, because for the longest time, they've been able to mess up as much as they want because of the eyeballs on their platform. But if we start to see like a real winner like homes.com, does that start to take away? And is it more of a structural issue for them?
Yeah. Zillow's in my too hard pile for sure. It's definitely in my too hard pile.
It's in my might not ever generate cash pile. I went to I checked out their investor day, and they expect 24% annualized revenue growth through 2025. They put that in based on their 2021 numbers, and their 2022 revenue was down like 16%.
Say that again. What was the number?
They put out like guidance or whatever, investor day guidance, and it was 24% annualized revenue growth
through 2025.
Yeah.
Well, the stock would be cheap if that works. However, let's show the cash flow.
No way.
Everything. Yeah, that doesn't seem likely, especially if housing. And what's interesting is we always see this stuff. You see it online. You see, everyone's interested in the housing market. A lot of people have exposure to it. You always see Zillow economist predicts, or Redfin economist predicts, or someone else that's not the digital ones, any sort of person. They're biased because they're incentivized to have the housing market be healthy. Right? Their incentive is to say that everything's going to be good. There's going to be lots of demand. There's going to be lots of buyers. There's going to be lots of liquidity. Their incentive is not to say the other thing. So I don't really trust those people when they talk about all that stuff and their guidance and the guidance for the industry, because they're biased.
And you know what's funny? Even with their obvious incentive for real estate to do well, real estate market to do well, they have all come out and basically said there's an affordability issue right now, and that it's going to have some sort of an impact. Rich Barton said it in his shareholder letter this year, which is the CEO of Zillow. Redfin has reports, and they honestly, props to them, because they have reports like every week that are like mortgage applications are down 50%. I'm like,
let's cut those expenses. How many economists do you have on staff? Let's cut that in half. They got heavy salaries. You guys need to make money first. Come on. We don't need these reports every week, right? But it's nice. I like them. But as an investor, I'd be like, hey, let's cut that. Let's cut that out.
I mean, I appreciate the candor, but I'm like, dude, it's gonna hurt your business. Like, you're hemorrhaging money, and you're seeing these reports every week. Last thing I'll say, because we're about to sign off. There was this is kind of a little more fun, but Howard Schultz, CEO of Starbucks, or temporary CEO for the time being, said they have come across a new transformational drink. It's coffee with olive oil. Is this the tailwind Starbucks needs?
Maybe. They say one thing about Howard Schultz. He has been pretty innovative from a product perspective.
Oh yeah, he's
this could
he
play
understands the consumer.
This could play big time into the keto bros. Aren't people like, oh, we put the butter in the coffee, it's some magic formula. I think this could work with that. People love talking about it. They're like, oh, healthy fats. There we go. It's a big, right? Isn't that kind of a trend?
I don't know.
I've seen that online.
I don't follow the keto fat enough.
Yeah, I follow the nutrition stuff. Here's the last swing. Here's my last question that I had on Walmart, on inflation, relates to real estate a little bit, I guess, because of interest rates. If inflation stays elevated, because we're seeing operating margins fall at Walmart, if inflation stays elevated, is it possible for general corporate profit margins, say the average corporate profit margin of the S&P 500, to not decline? Because when I see that, I think, okay, the earnings that we're earning, the earnings that the people are stating the S&P 500's multiple of like 20. It might actually be 25. It might actually be 30. That is not the way we invest, but it's just something that concerns me. And it feels like there could be some opportunities in 2023 if that occurs, because no way the market would be at a PE of 30. We'd see another 20, 30% drop.
No, yeah, margins would have to compress. Either here's my statement that might not make sense initially. If the cost of eggs continues to increase by 9% each year, and the cost of eggs is just a microcosm of inflation generally, housing prices will drop, or you will have a widespread recession across the rest of the economy.
Yeah, and by eggs you mean anything wherever
if
the
inflation
individual
stays
dollars.
high. Yeah, rates have to stay high, which means that like either no homes will be sold, or a very small percentage of homes will be sold, or prices will have to come down. There's no other way to do it.
We talked about this last week. I'm sure people are sick of it, but you have a circle, like say there's a pie of money that a person has each year, their personal income or household
median income in the US.
Yeah. If 20% of that more is going to household spending, or 20% more is going to something else, it's not like they have a magic place to get more of that. Well, they did during the pandemic, stimmies, but those aren't happening anymore. And yeah, it'll just be fascinating to see what happens. Where will the dollars flow? Because we know they'll obviously go to food, because that's key. And they have to go to shelter, but it depends what type of shelter. Are people going to lay down these mortgages at 6-7% with these prices? Are consumer discretionary items going to just fall to bed? Will travel pick up or collapse? It'll just be fascinating. And unless you have anything else, Ryan, we are running 2 minutes late, so I think it's time to wrap things up. If you're a regular, nothing else. These go live 12:30 p.m. Eastern time on YouTube every Thursday. Look up the Chit Chat Money YouTube and you'll be able to find it. You can subscribe to it, and if you even want, you can put the notification bells. But it's 12:30 p.m. Eastern every Tuesday. If you want to ask us any comments, and you can watch the replays there. You can listen to the replays Sunday mornings, as most people do, on Apple Podcasts, Spotify, wherever you get your shows. If you like our shows, subscribe to our newsletter to keep up with us. It's the Chit Chat Money newsletter on Substack. Give us a review on Spotify or Apple Podcasts to help support the show. Remember, we are not financial advisors. Anything we say here is not formal advice or recommendation. We are general partners at Arch Capital, and clients may hold securities discussed on this podcast. Thank you, everyone, for joining and watching. We'll see you next time.